We are going to have a discussion about the new concept, and for that, say, I'm taking a small example. Mm, I'm going to ask a question, so be ready for it. Suppose you want to buy some quantity of gold after 1 year. Let us say that say you want to buy some quantity of the gold after 1 year. Today, price of that is quantity of gold is rupees 60,000. Rate of interest is 20%. You go in the market to find a forward seller as you want to buy gold after 1 year. You want to buy certain quantity of the gold after 1 year. Today, that quantity of the gold has a price of rupees 60,000. Let us say that the rate of interest in the market is 20%. You go in the market to find a forward seller that whether somebody is ready to sell this much quantity of the gold in the market after 1 year, and you find that say somebody is ready to sell the gold to you after 1 year. Mr. X is ready to sell gold to you after 1 year at the rate rupees 75,000. You find a person called Mr. X who is ready to sell gold to you at the rate of 75,000. My question is, would you enter into forward contract with him? Question mark. Of course, the forward contract is to buy the gold after 1 year from him at the rate of 75,000. I want you to answer this question in the chat box. We understand that over here that the answer of the question would be no. Why? Let us understand. You will think like this, that today it is, let us say, 1st of January, and you want to buy gold after 1 year, that is on 31st of December. At the end of the year, you want to purchase, let us say, 10 gram of gold, and the price of 10 gram gold today, it is an amount of 60,000. Today the price of 10 gram gold is rupees 60,000. Now you want to purchase this 10 gram of the gold after 1 year. Mr. X is offering the price of 75,000 to you, this price. However, you will deny. Why? Because you will think something like this. Let's say, let us say that say you borrow rupees 60,000 now at the rate of 20% for 1 year. With that, say you buy the gold, you hold it for 1 year. At the end of the year, repayment of the loan would be 60,000 into 1.20. That comes to rupees 72,000. That is the way you can make the calculation of the like the effective cost of purchasing of the gold and holding it for 1 year, and that is having a cost of 72,000 rupees to you. So if at all this alternative is having cost of 72,000, then why would you buy the gold in forward market for 75,000? You will not agree to it. So now friends, we understand something like this, that what will happen if at all, that is, you will say that say no, I am not interested. He gives you the revised quotation of 74,000. Again, in that case, you will say no. What happens at say you are not ready to pay a price which is greater than 72,000? That is what we understand. Listen carefully. The person who wants to sell gold to you, if at all he is not a speculator, listen carefully. If at all the person who wants to sell gold to you is not a speculator, then from the seller point of view, again we understand that say he will quote you minimum 72,000. Because what he will think, that say today the gold is having worth of 60,000. There is an opportunity cost of 12,000. So we understand that say he will quote you minimum 72,000. In no case he will quote you a price which is less than 72,000. So friends, we understand that say theoretically forward price or the futures price is equal to spot plus interest. In a way that say the 60,000 is a spot price plus 60,000 into 20 percentage. So it is 60,000 plus 12,000. So theoretically the forward price or the futures price would be 72,000 rupees. That is what we understand over here. Friends, over here we may be provided with the information that say there is a cost to hold the gold, in a way that say, like if it is supposed to be kept in the demat account, then in that case the demat account charges. Or let us say that say we are provided that say you want to keep the gold in your locker and there is a locker rent. So we may be provided that, let us say in present value term, that is senior zero term, we are provided with the information about the present value of the storage expense. Let us say that the present value of the storage expense is an amount of 1,000. In that case, so the forward price or the futures price would be theoretically 60,000 price of the gold, 1,000, it is a kind of, we understand, present value of the storage cost, into 1.20. In a way it is compounded to end of the year. So 61,000 into 1.20. So in that case the theoretical forward price of the futures price will be 73,200 if at all we are provided with the information about the storage cost. Over here we understand basically from forward seller point of view, Mr. X point of view, over here we can say that Forward seller may wait for 1 year. So what will happen on 31st of December? Forward seller can buy gold, 10 gram of gold from spot market, comma, in order to give gold to me, that is gold to you. However, if at all, say he, that is Mr. X, is considering to purchase the gold at the end of the year at whatever the price which is prevailing, then in that case there will be a risk for Mr. X. The price of the gold keep on fluctuating. On 1st of January, he is required to give a fixed price to you, the price at which he will sell gold to you. That is the reason. So the one of the method by which he can have a fixed price at which he can give gold to you. For that, say he will consider like this. Let's say let me purchase the gold today and hold it for 1 year. If at all I purchase the gold today and hold it for 1 year, then effectively cost to me is 72,000, and that is the minimum price that I am supposed to recover on sale of the gold. So from forward seller point of view, the minimum price that say he will charge is 72,000. I request you to write down heading calculation of F price. In bracket I am writing F is equal to forward slash futures. In that write down, friends, over here one thing that I want to, that is clarify, that say whenever we are doing a kind of theoretical price calculation, at that time we are required to make the calculation as if we want to reach to the break even point, in a way that say we want to know that say what is the theoretical price. Theoretical price will be such at which a kind of no profit or no loss will arise. That is what we understand is the theoretical price. I give you some more example. Suppose say there is an investment decision question wherein the question says that you are going to purchase a machinery which has a life of 3 years. Cash inflow on purchase of machinery is 3,000, 5,000 and 10,000. Your cost of capital is 25%. The question says that say what is the maximum price that say you are ready to pay to buy the machinery. In this case, what do we do? In this case, we make the calculation of present value of the future cash flow. End of year 1, end of year 2, end of year 3. So this is 2400, this is 3200 and this is 5120. So the total is 10,720. So basically the maximum price that say you are ready to pay is equal to the present value of the cash inflow. Now when you are making investment of, let us say 720, then in that case you will end up with the NPV 0. Now when you get 0 NPV, then in that case what is the gain? However, whenever we are required to answer that what is the maximum price that you are ready to pay, then in that case we have to give answer in such a way so that at that point of time we are at a kind of break-even point. Always in the financial management, the valuation is done like that. I request you to write down the heading calculation of F price. F stands for forward slash futures price. In that write down first point. In that write down first point. over here we understand that F price is calculated from forward purchaser point of view. Forward or futures is one and the same. Second point, equilibrium price is calculated in such a way so that there is no profit, comma, no loss to forward slash futures buyer slash seller. Third point, F price is calculated using following formula. In the breakdown, S plus present value of storage cost प्लस इंटरेस्ट कॉस्ट या उसको कैरिंग कॉस्ट भी बोला जा सकता है, इंटरेस्ट कॉस्ट और कैरिंग कॉस्ट माइनस डिविडेंड इनकम कंपाउंडेड. What do we understand with the term dividend income compounded? I just explained that to you in some time. But write down this formula. This formula will give you, that is, this formula will be helpful to you in all the questions. We are going to understand its impact slightly later on. And of course, we understand that, say, if at all the storage cost is given to us in compounded value term, that is in the year end term, then the carrying cost will be calculated only on the spot price. So F is equal to forward slash futures price. S stands for spot price. PV stands for present value. That is what we understand. Let us see our next question. On 1st of January, a situation as under is prevailing. Spot value of the commodity is 50,000 rupees. Rate of interest is 20%. Time period is 1 year. You are required to answer following questions. What should be forward slash futures price of the commodity so that arbitrage does not exist? Friends, the term arbitrage stands for risk-free profit. It means that the question says that, say, what is the equilibrium price that is required to be calculated. So what should be the equilibrium price of the commodity for 1 year forward contract? That is a question. I request you to calculate the answer and put your answer in the chat box. So friends, over here f is equal to s plus interest because no other adjustments are there. So it is 50,000 plus 50,000 into 20%. Directly the time period is 1 year. So 50,000 plus 10,000, that comes to rupees 60,000. Right on with paragraph. Such F price so that arbitrage does not exist means theoretical F price. Full stop. At that time, there is no risk-free profit available. Full stop. We are going to understand the arbitrage concept further.